Hi, Todd Rosenbluth, Head of Research at VettaFi. Thanks for joining us for our latest episode of ETF360. I'm joined by Tim Urbanowicz of Innovator ETFs. Tim, thanks for joining me. How you doing?
Great to be here, Todd. Doing great.
Well, we've got a great market so far in 2023. Markets climbed really higher, but there's obviously some risks ahead for the year. What do you see as we go forward in the next 12 months?
Yeah, well, Todd, I'd say there's really two risks that we're focused on right now. The first and most important really comes down to how long we're going to need to see rates at this restrictive level. If you look at corporations, you look at consumers, up to this point, both have digested rate hikes extremely well. And a big reason for that is neither really have much floating rate debt exposure. A lot of fixed rate debt that's locked in for some time. The longer we go, however, the more those rate hikes are going to sting. You look at corporations as an example, the gap right now between where current coupons are versus the current yield to worst on debt, it's at the biggest level that we've ever seen. And if you look over the next 2 years, 2024, 2025, we have about 14% of ex-financial debt coming due in the S&P 500. That's not an insignificant number. So we need to be able to get to a point where the Fed can cut and rates come back down so that we don't see this huge shock to the capital structure. So that's really the first risk. Yep, and I think the second risk that we're seeing is just a lot of the complacency and a lot of the good news that's already been priced in. If you look at the S&P 500 as an example, you're trading at 20, 21 times earnings. Expectations are for about 12% earnings growth next year. That's very aggressive given the macro backdrop that we are seeing, and again, with where rates are. So a little bit of bad news has the potential to really shake some of the good news that's already been priced in.
So do you think that's why advisors have a lot of money sitting on the sideline, a lot of cash sitting there? Are they trying too hard to time the market?
Yeah, it's interesting, Todd. Cash is at an extreme right now, and especially for the high net worth individuals that the advisor is servicing. If you look right now, high net worth individuals hold about 34% of their assets in cash. That's up significantly over the last couple years. And, I'd say it's probably less about trying to time the market and really more so what the end client is driving. What we have found is, when we're talking to advisors, really more than anything else, their clients want to remove unknowns. They hate unknowns. So they're looking out there right now. They see a lot of the headwinds. They see the recession risks, and they also see, cash yields, at 4, 5, 6%, pretty attractive. But we all know in the short term, and especially in the long run, getting out of the market and being in cash is a mistake.
So thanks, Tim. Can you tell us about SFLR, one of Innovator's ETFs?
Yeah, absolutely. So SFLR is the equity managed floor ETF. This is an actively managed ETF sub-advised by Parametric that seeks to give equity exposure with a 10% floor against losses. So very simply, how the strategy works is it holds a basket of U.S. equity securities that are designed to track very closely with the S&P 500. On top of that, we hold a portfolio of downside puts to create that 10% floor. And then in order to fund that, what we do is we use Parametric's short-dated call selling strategy really to offset the cost of that protection. So you put those three layers together, and that's SFLR.
So lastly, how do you see advisors using the ETF?
I would say, the majority of advisors that we have using this strategy are doing so as a core equity position. If you look at since the strategy launched in November of last year, you have the S&P 500 that is up about 18%. SFLR has captured about 92% of that upside with 30% less volatility. And bear in mind, all the while, we had that 10% floor that we were targeting. So really a way to just have some risk management in place, but still use it in the core equity sleeve of the portfolio. Additionally, we also have seen a lot of advisors that have used this as a way to really reduce some of the other pockets of their portfolio, like fixed income or alternatives that are typically there to hedge downside risk, using this strategy really as a way to get more equity exposure into their portfolio. And in the long run, the hope is that will increase the overall returns of their portfolio.
Thanks, Tim. Thanks for sharing expertise about SFLR. Folks should tune in and learn more at etftrends.com. Have a great day.